Eugene Musikatsi from The Real Forex. Well, today I'll be discussing conjunction of several indicators, because last week people were asking me about some indicators and how to use several indicators, and I've always emphasized that you can never trust one indicator alone as a source of an entry or an exit, because there's no indicator that is 100%. Now the question becomes, how do you enter in a trend that is already in motion? You understand? So today I'll be discussing the Fibonacci, the RSI, support and resistance, and the divergence, and how to use all of these tools in conjunction, because that is what you call a trading strategy. A trading strategy is not support and resistance. A trading strategy is not RSI. It's not a moving average. It's a combination of indicators, candlesticks, support and resistance, and other things that come together to give you one conclusion. Now let's go to the video. Let us go to the lesson. Fibonacci retracement. Fibonacci was a scientist, a mathematician back in the 11th century that came up with a sequence of numbers, and these numbers have been used in nature, in galaxy, and to measure several things, not only in Forex. However, traders and other people have found a way to actually implement these numbers, and they've proven themselves to be very effective in determining the retracement of a trend, like knowing how to enter or where to enter on a trend that is already in motion. Under Fibonacci, I'll be discussing the retracement, impulsive and corrective moves, support and resistance. Now, under RSI, I'll be talking about overbought and oversold, and the divergence. Now, the question becomes, what is Fibonacci? Fibonacci, I've already explained the history. I will not dwell too much into the mathematical side of things, since this is trading. I will just go a little bit into history so that you understand where we come from. Now, as I've explained that Fibonacci is a sequence of numbers, how did they come about this sequence of numbers? Alright, 0 plus 1 is what? Is 1. 1 plus 1 gives you what? 2. Alright, 2 plus 1 gives you about 3. 3 plus 5, 3 plus 2 gives about 5. Alright, 5 plus 3 is 8. 8 plus 5 is 13. 13 plus 8 is 21. 21 plus 13 is 34. And the sequence goes on and on and on. However, these are really not Fibonacci levels. The ratios that you get when you divide these numbers, that's what gives you the Fibonacci levels. Alright, and the most important Fibonacci levels are 38.2, 50%, and 61.8%. And how do you come about these numbers? Let me just give you one example. 1 divided by 2 gives you 50%. And when you divide 13, 80 divided by 13, it will give you about 61.8%, and the number goes on and on. Now, these levels help you determine or predict where the market is going to turn when the market retraces. Let me go to the next slide to show you what do I mean by that. For you to use Fibonacci, first of all, you need to identify a trend, which means you need to identify the direction of the market. For example, say that the market is going up, down, but the general movement is upwards, right? Now, if the market is already in motion, how do you enter the market? How do you enter the market? Where do you enter the market? You enter the market when the market comes to break, take a break, push up, take a break, push up, all right? On these levels. Now, how do you determine where the market is going to turn? Say that the market is going up, and then start coming down when people take their profit. How do you know, or where is the market going to turn? This is where the Fibonacci level comes in, whereby the market may turn around these levels in Fibonacci when you apply Fibonacci. When the market goes up and then comes down, the market may turn around 38.2, 50%, and 61.8%. However, personally, I prefer using 50 and 61.8% because they are major pullbacks. And with major pullbacks increases the possibility and the strength of your Fibonacci zone. You understand? Guys, for you to be able to use Fibonacci to your advantage, the first thing that you need to do is to identify a trend. And as you can see, this is an uptrend. The market has been going up. Now, let us just zoom in so that you are able to see everything clearly. Say that the market is here at this point, right? You don't have the rest of this. The market is just here. Now, the market start pushing up. The market is here, right? Create this is a low. You understand? This is a lower high. It's a higher low. It's a higher high. Higher than the previous one. This is a higher high compared to this one. Now the market went there. Market moved here, went up here, came here, and pushed up. Now when I was talking about corrective move, the market is pushing up and then create what? A corrective move. It's correcting, it's taking a break, it's breathing. People are taking out profits. And then the market continue pushing up. Now, how do you buy on a market or on a price action that's already began and it's moving in the direction already? Because you can't just buy here, you can't just buy here. What if you buy and then you're buying here, then the market push down and blow your account? You need to know where you can buy. And this is where Fibonacci comes in. So what you do is you click on Fibonacci, put your Fibonacci on the lowest point of the market at that current price, then you push it to the highest level where the market has been rejected, which is this level. All right. Now, where do you enter? Remember when I was telling you about those important numbers? 50%, 61.8, 38.2. You remember those levels? That's where the market is most likely to turn and reverse and continue moving on the upward direction, as you can see. Now, look here. This level is 50%. This level is 61.8%. This level is 38%. These are where the market is most likely to respect or to turn. Now, check what the market was doing. The market went up and turned down and continued going up. The market turned here. It's not a coincidence, guys. This is the 50 and 61% zone. We call this the what? The Fib zone. You understand? Now, remember when I told you that you can use this strategy or this indicator in conjunction with the support and resistance. The market was pushing up. All right, the market pushed up. However, when the market created a resistance, a support here, the market was rejected 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 here. You understand? Which means this level is more like a support. Now, when the market goes up and come down, which means this is your support, and then the market come and respect this level. So which means you have two things. You have a support, you also have Fibonacci level, which is your Fib. So you have two things, guys. Guys, this is easy. This is easy as a belief, man. Stop bombarding your market. Stop bombarding your chart. Keep it simple as possible. Keep it as simple as trading is not about knowing a lot of information, guys. It's knowing a little information, but use it to the best of your advantage as you can. You may think I'm a fluke. Let us go to another pair. You understand? So that I can show you this works, guys. Let us go to GBP/USD. Yep. Where can I go? Okay. Let's go here. This is also an uptrend. It's going up. Now, let us introduce Fibonacci. Remember, lowest point, highest point. Get it? Yep. And now, where the market is going to turn, you expect the market to turn around 50% and 61.8%. And let's check if that's what it turn. The market turn around this level, and check it. It's 50% again around that zone. That's where you enter, guys. That's where you enter. That's where you buy. You understand? Because if you bought there, guys, you will have lost your money. You will have blown your account. Know when to and how to enter. However, guys, you need to use this in conjunction with candlesticks. Don't just use this alone. I will post another lesson whereby I explain how you can use this in conjunction with candlesticks. All right. Now, where does the support and resistance comes in this instant? Let's push back. You see here, the market was pushing down, right? And then created a base here, and then pushed to the lower side, and then start pushing up. However, it broke that level, did not respect this level, and when it came back, it respected the level, which is the level that before was seen as a base. Is the base. You understand? So that's where support and resistance comes in. The market went up, came down, respect the Fibonacci level, and also respected this base. So you have two confirmations. It's not a fluke, guys. This system works, but you need to follow the rules. You need to use the strategy correctly. Well, RSI, personally, I'm not going to explain this according to the books. I'm going to explain this according to the way I use it and how I understand it. Well, I use RSI for determining when the trend is exhausted. For example, if the market is going up, when do you stop buying? How do you know that, okay, this market might turn down anytime? Maybe I need to start selling. That's how I use the market. And also, I use RSI for determining the strength of my trend. RSI. All right. Well, this is my RSI. Let me just show you how to insert the RSI indicator first before I start. You go to indicators. You type RSI, insert your RSI. You can actually play around with the settings, but as told you guys, I'm not going to complicate anything for you guys. I'm going to make it as simple as possible. All right. Now, let's focus on this part. The market has been on an uptrend, right? It was moving up. However, the market was rejected here, and rejected here, creating a what? A resistance. And right there, the market started pushing down. Why? And then when the market got here, it was rejected and started pushing up. Why? How do you know that? Say that the market was pushing up and you want to buy because you believe there's an uptrend, and then the market got rejected here, then pushed down. You're going to lose a lot of money. You're going to lose your money. Now, the reason I'm using RSI in this manner is because I've told you that there are two levels which are important. The three levels is the 70%, look there, 70%, 50%, and 30%. Forget about the 40, forget about the 60 for now. Now, this level here, you see that this level here was above 70. This level was above what? 70. And now also this level here, if you check, when it was coming down, this level is around what? Below 30. Now, when the market was here, it was what? Overbought, which means do not buy. It's not safe to buy. Even though it's an uptrend, it's no longer safe to buy. You need to wait to the market for the market to fall before you can buy to hit the lowest point. You buy low and you sell high. Let's just look for another high. The market came down here, right? The market was there, pushed down, came here. Now when the market was here, the RSI was above 70. When the market came here, the RSI was what? Below 30. This is your 30, this is your 70. This will tell you guys, like, it works like that all the time. But you cannot use this alone. You need to use candlesticks. You need to see your rejection. Let me just show you. Look at this candle. Look at this candle. Look at this candle. The rejection candle. You understand? And even if you come down here, there's a rejection candle here. So you need to use these things in coordination, guys. You need to use it using support and resistance. You need to use candlesticks. You need to use Fibonacci. You understand? Always use them in conjunction. Now let me go to a chart where I'm going to use everything that I've just taught you in one chart.
Cause I'm in it for the paper.